Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today we're going to talk about your 401k and how to get the most out of it to help you set up yourself for a successful retirement. There's about $8 trillion in 401k plans, and a recent Fidelity analysis concluded that there were about 500,000 people in the U.S. with over $1 million in their 401k. Before we talk about how it's basically the centerpiece of most people's retirements, let's take a look back at how it got to that point. So it was born out of a tax code change in 1978. Congress passed the Revenue Act of '78, which included a section that would allow employees to avoid being taxed on deferred compensation. And it was specifically Section 401k, which allowed employees to defer a portion of their salary into a retirement account on a pre-tax basis, meaning that, like as we know, the 401k, the money's not taxed until it's withdrawn. So you get to have that tax deduction up front, plus your account is growing tax deferred. This initially wasn't designed as the beast that the 401k is now known now as this comprehensive retirement plan, but it was really initiated to be a tax break for executives who receive bonuses or other forms of deferred compensation. Prior to that, pensions were the predominant retirement plan. And then since that passed in 1978, over the next couple of years, it morphed into a plan where not just executives utilized it, but all employees could start and contribute to a 401k plan for retirement savings. The 401k plan wound up gaining significant traction in the 1980s because companies now saw it as an attractive alternative to traditional pensions. With the 401k, employers could match employee contributions, so they're making a contribution to it, but they weren't obligated to cover the full retirement payout as they were with pensions. So with a pension, the company is on the hook to making sure that the funds are there and, for what they say they are. It shifts with the 401k. The employee is on the hook for saving, and then when they retire and they separate from the company that they're working at, that they take that 401k with them, and whatever they can turn that into, however they want to spend it, it's up to them. But all the risk is now on the employee side for making sure there's enough money in there to finance their retirement. So by the 90s, actually, 401k plans had become the primary retirement savings for millions of Americans. Today, they're the cornerstone of retirement planning for employees, and it's a vital savings tool. If you don't save in your 401k, you better have saved somewhere else. Otherwise, you're in for an awakening, or when your income does stop. So because of their importance nowadays, I wanted to have a podcast, and what I'm going to do is break it up into a couple different episodes because there's a lot of things that are involved in a 401k, and a lot of times I think the participants or the investors kind of look at it from a simple landscape, but there's different investment options that you have to make. You have to decide whether you want to make a pre-tax or Roth contribution. These plans are even growing most recently, where now people are automatically getting enrolled for them. There's contribution increases that you have to think of. There's different options on the plan where you can take a loan. So obviously they're very accessible, but they're also very customizable for participants. So I wanted to kind of focus on the three questions I get asked the most on 401ks. The first question we're going to look at today is, should I make my contributions to my 401k as Roth contributions versus pre-tax contributions? Let's give a little background on your 401k. So, a lot of people, they'll look at their 401k balance and they've made pre-tax contributions throughout the years, and they see this big balance in their 401k because it will grow. However, one thing they don't realize is that not all of their 401k is theirs. They have a partner in their 401k, and the partner is Uncle Sam. And the reason for that is if they're utilizing the pre-tax, which is the traditional 401k, it's the one that it started as and the most common one, they're getting a tax deduction for every contribution they make in that. So let's just use the simple example that someone earns $100,000 a year. They add $5,000 to their 401k. When they look back at the income tax they paid on that $100,000 for the year, they wouldn't have actually paid it on $100,000. They would have paid it on $95,000. So they're getting a tax deduction for making that contribution. Now, the government is always going to get their tax, so what they do is you'll get taxed when you do retire and you take the money out of the 401k plan. This is the traditional 401k contributions that we're talking about. There's also a Roth 401k, which it's a feature that it's getting to the point where most employer-sponsored 401k plans allow you to make these after-tax contributions. So the way that works is you pay tax on $100,000, and let's say you make that $5,000 contribution to a Roth 401k. You've paid tax on that money. However, unlike the traditional or the pre-tax where you pay tax when the money comes out, you don't pay tax the Roth 401k. So you get the tax benefit at the end versus the beginning on the pre-tax. A couple different things that's set. So a lot of people are familiar with Roth IRAs. Roth 401k, it's similar in that the same way that it's taxed, but slightly different. There's no income limits on a Roth 401k, so it allows high earners to participate. It has a higher contribution limit than Roth IRAs. So someone who wants to sock away a lot of money in their retirement accounts, a Roth 401k is good for that. Like I mentioned, you're contributing after-tax contributions to it. It's growing tax-free. So once you made that Roth contribution, your investment grows without having to pay tax in it. Your withdrawals in retirement, so any money that you take out, including the earnings over the years, are tax-free as long as you meet some certain requirements, which is usually you're 59 and a half and you've had the account open for at least 5 years. And then if your employer offers a match on the 401k, you're able to have those contributions go into the Roth component as well. So if we look at advantages of it, there's the tax-free withdrawals in retirement. There's tax diversification. So a lot of people will start off with pre-tax just because it's that you want that instant gratification of getting the tax deduction in the year that you make it. Roth is a way to add some tax diversification or kind of take the tax brackets out of the equation. Obviously, no one knows what the tax brackets are going to be in the future, but if you have money in a Roth, it doesn't matter. So even if the brackets go up to 50%, 60%, having that Roth, you'd be able to pull out the funds without having to pay tax. Whereas in the pre-tax, you'll know what you'll get your tax deduction at now, but you don't know when you take the money out of your pre-tax 401k later, when you do retire, you don't know what tax you're going to owe on that. There are some disadvantages to the Roth contributions. Like I said, you don't get the immediate tax break. And the thinking of why people would use the pre-tax is that the theory is in the future you're going to retire and your income is going to be less, and therefore you potentially would be in a lower tax bracket, and therefore you're getting a higher tax deduction up front when you make a pre-tax contribution to your 401k, and you're going to pay less tax on the money that comes out of it in the future. Now, that's not always the case. Some people are in higher tax brackets are in retirement. Now, going back to the tax brackets. If you're certain for some reason that you'll be in a lower tax bracket now and you expect to be in a higher tax bracket later, Roth contributions are probably more beneficial. Now, why might you be in a lower tax bracket now than in the future is, let's say you're just starting out and you're just starting to work. Roth contributions on that side are really good because there's a high probability you'll be in a higher tax bracket than when you do retire. If you're in a high tax bracket now and you do think you'll be in a lower one in the future, pre-tax are probably the way to go, just because you'll pay tax at a lower rate in the future. Going back to that tax diversification strategy, it doesn't have to be all or nothing. A lot of people think, I have to put 100% of my contributions into either pre-tax or into Roth. Some people split them up 50-50. Some people will contribute a couple of years to Roth and then switch over and contribute some to their pre-tax. So you're not locked into any decision. Just talk about a couple things on matching. So matching is when you make a contribution and the 401k plan has an option or stipulation that says your employer will match some of your contribution. The way it used to work is even if you made Roth 401k contributions, the employer match would be made to a pre-tax component of your 401k. And the reason for that was that someone has to pay the tax and the employer is getting a deduction on their side of the contribution, even if you had Roth 401ks. However, under the Secure Act 2.0, employers are now allowed to make matching contributions directly to the Roth portion of the employee's 401k. So the way that works, though, and that's a little bit different, is that the Roth employer matches, they actually come in show up as taxable income in the year that they're made. So that means employees will pay taxes on the match amount, but again, you get the funds in the Roth component, and then you don't have to worry about taxes going forward. Next thing that resulted in the change is required minimum distributions, or RMDs, for Roth 401ks, and this is also a change that was part of the Secure Act. Roth 401ks are no longer subject to RMDs. Previously, there was a difference in the rules that applied to Roth 401ks and Roth IRAs. Roth IRAs were not subject to RMDs, but Roth 401ks were. Now, neither of them are subject to RMDs. Another thing I wanted to talk about with respect to Roths are the mega backdoor Roth. What this is it's a strategy where investors can potentially contribute an extra $46,000 to a Roth IRA or Roth 401k in 2024. Now, the reason why someone might want to do this is they may want to contribute more than what the standard contribution limits are, and utilizing this mega backdoor Roth is a way to do it. It's a little bit complex in how it's done, but it's, like I said, it's worth considering if you want to contribute more money. Not every plan is eligible to do this. I think at one point it was projected that 50% of the plans allow this mega backdoor Roth. You may have to check with your HR department or the plan sponsor on the 401k just to see if you're able to do that. And what's the benefit of this is, one, you can get a lot more money into a Roth. The Roth IRA, it's actually somewhat limited in terms of if your income is over $161,000 if for an individual, or $240,000 if you're married and jointly, you can't contribute anything to a Roth IRA. But the benefit of this mega backdoor Roth is that even with high incomes, you can really sock away a lot of money. And the way this works, so the actual execution of this is you make your maximum pre-tax contribution to the 401k, which in 2024 it's $23,000, and then if you're over 50, it's $30,500. Then once you reach your maximum pre-tax contribution, you can make an additional after-tax contribution to the 401k limit for the year. So that total limit for the year is $69,000 or $76,500 if you're 50 or older. In that limit, it's included as the employee's contribution, any employer's contribution, and then this after-tax contribution that we're talking about. The final step here is you roll over that after-tax contribution that you made into a Roth IRA, or if the plan allows it, you can convert it directly into the plan into a Roth 401k. Benefit again here is that you're getting a big chunk of money into a Roth account, whether it's the IRA or the 401k. So the plan must allow in-service distributions or conversions to a Roth account. In-service means that you're able to make that distribution while you're still employed. And then obviously the other caveat is you have to have the cash to be able to make it. So if you're making an extra $46,000 contribution, the cash has to be there to be able to make it. So like I said, if you want to at least explore whether you're allowed to do this, talk to HR, talk to the plan administrator, plan sponsor if you're able to do that. So hopefully this gives you some insight on how to decide whether to make a Roth, pre-tax, or both types of contributions. If you'd like to discuss the details of your specific situation, I'm happy to talk. You can set up a free complimentary consultation at bautisfinancial.com/call. And then on the next episode of this 401k series, what we'll talk about is two other questions that I see a lot of participants having, and that's how much should they contribute, and then how should they allocate their funds.
Don't forget to follow the Agent of Wealth on the platform you listen from, and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.